All right, chapter 13 is called Corporate Formations and Operations. Section 351 basically talks about deferring gains and losses on items that are donated, or I shouldn't say donated, but are contributed to the company as a form of capital for a company in which the person donating or contributing the assets is also an owner or shareholder. So in order to qualify for this Section 351 tax deferral treatment, you have these specific requirements. So it's obviously got to be some property, not services, so that's pretty straightforward. In exchange for stock of the corporation. So you need to be contributing this in exchange for stock in the corporation, and because of this contribution, you need to control more than 80% of the corporation after the assets are contributed. So basically, it works kind of like this. A company, for instance, may want to use its assets, for instance, its own stock, to purchase the controlling interest in another company, thereby taking it over. So you can think about it this way, that it just wouldn't be terribly fair to a company if it is contributing the equivalent of cash, so basically paying a company in order to buy its ownership and take it over, and basically, I'm sorry, I kind of messed up the way I was trying to explain that, but what I mean is, it's not fair if you have this particular piece of asset that has gone up or down in value. The IRS is really just trying to say, if you are doing whatever transaction you're doing to now control the company, and you're using property to do it, typically property that's gone up or down in value, we will not make you report that as a gain or a loss until it's actually sold or given to another entity. So this is basically saying, hey, if you're in control of the corporation at the end of the day, then you're not really giving up control to another entity. In other words, the assets that you're contributing, you're really just giving back to yourself. So they're going to let you, the IRS is going to let you not recognize any gain or loss that's sitting there, assuming that you are then in control of the entity afterwards. So when you get something other than property, which is called boot, and it's generally cash, but can be other things, then you would recognize a gain, but not a loss, in an amount not to exceed. So this is an upper limit on this gain that you might recognize here. The upper limit is either the gain that you realize or the fair market value of the boot received. Obviously, if that's cash, then the fair market value is its actual value. Okay, so how you treat the gain obviously is going to depend on the type of asset that is being transferred. So depending on the nature of the underlying assets, it could be recognized as any of these different types of gains that you would normally run into. All right, so let's look at an example. Example 1, suppose Sarah received 25% of the CCS stock in exchange for services, Nicole received 50% of the stock in exchange for appreciated land, and Chance received 25% of the CCS, I'm sorry, if I said 25% originally. Obviously, these add up to 100%. So anyway, Chance receives 25% as well. And the question is, must Nicole recognize the gain she realized on her transfer of appreciated land? And the answer would be yes, because as you can see there, after all of these transfers take place, she will only own 50% of the company, which is not that 80% required for control. So yes, the transfer there, even though it would otherwise meet the requirements, does not meet the ownership requirement. All right, example 2, when incorporating CCS, Nicole transferred a parcel of land held as an investment for 5 years to CCS in exchange for 50% of the corporation's stock, 50 shares valued at $100,000, and its tax basis to Nicole was $40,000. Assuming the transfer qualifies under Section 351, what gain or loss does Nicole recognize on the transfer? What is her basis in the stock she received on the exchange? What is her holding period in the stock? Well, we didn't talk about all of these things necessarily yet. But yeah, you get a $0 gain recognized because there was lack of boot, and we already said she met all of these Section 351 requirements. As far as the holding period goes, well, why do we care about the holding period? Obviously, in determining whether it's once we finally do get rid of it, determining the nature of if we get a gain or a loss on disposing of it later down the road, then obviously it's important there. All right, example 3. What if Nicole contributed land she held as an investment, fair market value $90,000, basis $40,000, and inventory, fair market value $30,000, basis $26,000, to CCS in exchange for 50% of the CCS stock, and $20,000 cash in a qualifying Section 351 exchange. What percentage of the $120,000 value received by Nicole was received for the land and the inventory, respectively? So essentially, how do you determine what percentage goes to where? Total amount received, and then you just have a ratio with obviously that 120,000 on the bottom and either 20 or 100 on the top, and you would come out with those ratios. Now, once we have those ratios, then because of that, well, I'll look at that here on this next one. What amount of gain does Nicole recognize on the exchange? What is the character of the gain? Okay. So all we got to do is look at the two assets here. Amount realized from the stock, amount realized from the boot that's attributable to either of these two. Which means that's the total amount realized. Obviously, we've already been given the adjusted basis. So that leaves us with a gain here of $50,000, a gain here of $4,000. We look at the boot received for both of those assets, or at least the portion of the boot that we are attributing to both of those assets. So $15,000 going towards land, $4,000 here going towards inventory. Then we look at which is the lesser of either the gain or the boot realized, and we use that number. So for the land, that would be the $15,000 boot. It would be a capital asset because of the nature of the land. And then inventory would not be a capital asset because it never is. its underlying nature is not that of a capital asset. So yeah, we just have the general rule there, the assumption of of what you do with the assumption of shareholder liabilities by the corporation. Shareholders' liability attached to the property is not treated as boot received. So if you're taking land subject to this liability, that's not the same as taking or receiving cash, at least that is the general rule. Now, if the IRS believes there's a tax avoidance purpose, or basically when they say there's no business purpose, they mean there's no reason you would do it other than a tax avoidance purpose, so they're not going to let you get away with that. Anytime you've got liabilities in excess of basis, shareholder recognizes the gain to the extent that the liabilities assumed by the corporation exceed the aggregate basis of property contributed. So if the overall gain, if the overall liabilities are more than what the basis of the asset was to begin with, then again we're assuming that there has to be some other reason that a company would do that, because they're not just going to assume more liability than the property's worth. So that would be an exception there. All right. Example 4. Suppose that when forming CCS, Nicole transferred a parcel of land held as an investment to CCS in exchange for 50% of the CCS stock. That's 50 shares valued at $100,000. Land's fair market value was $150,000, and its adjusted tax basis to Nicole was $40,000. The land was subject to a $50,000 mortgage that CCS assumed on the transfer, which is not treated as boot. Assuming the transfer qualifies under Section 351, what is the amount and character of the gain Nicole will recognize on the exchange? Okay, let's take a look at this. This is basically testing the how well we absorbed that last thing I just said there, where if the underlying liabilities assumed by the company are more than the value of the asset that they're taking, whatever the difference is to make it a wash, we're going to assume that in this case, let's see, yeah, so the $50,000 more, I'm sorry, yeah, the $50,000 mortgage is greater than the tax basis on the asset. So therefore, the difference between those two, we're going to assume is being compensated to Nicole some other way. In other words, why would she part with this asset? Well, I'll just leave it at that. Just leave it at that. Just remember, I like to sometimes try to give an explanation as to why the IRS does stuff, but that's kind of a slippery slope. So just remember that if the asset or if the liabilities that are being assumed are greater than the tax basis of the contributor on those same assets, then we are going to recognize the difference as a gain. All right. Yeah, you guys should have a pretty good idea how this is done. But as far as the computation of the tax basis of stock received in a Section 351 exchange, we obviously would start with the cash contributed. To that, we would add tax basis of any property that was contributed. We would add any gain that was recognized on the transfer. Subtract out the fair market value of boot received for stock, again, usually cash. So would be whatever value of cash that is. And then we would subtract out again liabilities assumed by the corporation on any property contributed. And that gives us our tax basis. All right. Corporation's basis in the assets it receives from a shareholder are essentially the same basis that the shareholder had, and to that you would add any gain that the shareholder recognized as well, and you would tack whatever the shareholder's holding period was. So if they had already had the asset for a year, then we would assume that it was just as if you had had the asset for a year as well. You can take a look at that slide. I don't have too much else to say about that one. This would be a good one to bookmark, obviously, comparing the corporate tax formula to the individual tax formula. Obviously, there's a lot of stuff missing here that makes it less complicated, other than the deductions are no less complicated, and many times far more complicated. But it's a fairly straightforward equation, but we'll need to refer back to it frequently. Basically just saying, hey, most companies have both a set of books for taxes and a set of books for financials. So you'd start with, well, I guess I said that a little bit wrong. You're not actually keeping track separately throughout the whole year. But when it comes time to do taxes, you're going to kind of recalculate things, starting with your financial income, and then you will eventually get to taxable income. Doesn't really so much matter to know unfavorable versus favorable. That's just a way of talking about it, essentially. But it is important to know that some of the differences between our income on our financial statements is going to be because of differences in the timing of when we call something income, and then there'll be some things that are different just based on what our definition of income, or at least taxable income, is. So for the ones that are a timing difference, those are going to be temporary, and eventually, if you looked at the full life of the company and compared incomes, those differences would eventually come together by the end of the company's life. Permanent differences would be items that we're never going to have to pay taxes on, essentially. It's not just that we're not paying them in the same timing as with financial accounting. So here's a couple examples of some common book tax differences with their little terminology thrown in there as well, as far as which is favorable, which is unfavorable. So those would be the permanent ones, and then here would be some temporary ones. Just take a look at those. We'll get into, when we're working through some of these items in the coming weeks, we'll obviously talk about some specifics of these more and spend more time on the overall equation in general. Yeah, I'm not going to get too much into the stock op. This is a little beyond the scope of this class. You can take a look at this slide yourself. I'll just skip through the stock option examples here. Sorry. All right, let's talk a little bit about net capital losses. No current deduction for net capital losses. This is slightly different than well, we're saying there's no deduction on your regular income for net capital losses. So unlike individuals where you get a few $1,000s that you're able to, of your capital losses that you would be able to count against your personal income, for corporations, that's not an option. Let's see. Net operating loss deduction, obviously this would be your having a net loss for the year on your income statement. You're able to go back 2 years or forward 20 years. Obviously there's not going to be any real current benefit other than, you're not going to pay income on income that you didn't make. I'm sorry, you're not going to pay income tax on income that you didn't make. So why would a corporation forego the carryback? It's all about, when you're going to take a deduction is all about when you can maximize the value. So if it's more valuable to you to carry it forward, in other words, maybe you think you're going to be in a higher tax rate further down the road, or just in worse need of deductions, then obviously it would make more sense to use it later rather than earlier. And again, it's just going to be about trying to maximize value. All right, when you're computing net operating loss, you're not going to take anything out for any carrybacks or carryovers from other years. So anything that you're carrying over. So I guess I should say you establish whether you had a net operating loss this year before you use any carrybacks or carryovers. Okay. Let's look at an example here. CCS has a net operating loss of $20,000 for the 2017 tax year. CCS reported the following taxable income from 2014 through 2016. $10,000 in 2014, $17,000 in 2015, $8,000 in 2016. What options does CCS have with respect to the current year net operating loss? Well, we could carry it back $17,000 to 2015 to wipe out our $17,000 of taxable income there, and then we could use the rest of it in 2016, or and obviously these would be amending past returns would get us that money back right now, or we could go forward and carry it forward, assuming we think we're going to get more value from it there. For charitable contributions, we're going to look at the market value. Typically, if it's a capital gain type of property, I should say, and if it's ordinary income property, or in other words, property that would not qualify as a capital asset, in other words, and also not qualify as a capital gain, then we would just use the adjusted basis there. We're assuming most corporations we're talking about are going to be accrual basis, so in that case we would deduct whenever the contribution was approved by the board of directors before the year end, assuming it was paid within 3.5 months of the close of the year. We're as corporation limited to 10% of taxable income before deducting these items. So taxable income, when we establish this ceiling as to the amount we can receive a deduction for, we're not going to take any of these things out of our taxable income when we do this 10%. So these will all still be in there. And then anything we donate in excess of the 10% we can get a deduction on this year, we can carry forward into the future. All right, so let's take a look at this example. And we'll probably close with this example today. Assume that CCS's 2017 taxable income before considering the charitable contribution limitation was $40,000. The taxable income computation includes a $5,000 charitable contribution deduction, a $1,000 dividends received deduction, a $2,000 domestic production activities deduction. What else here? $12,000 depreciation expense. So under these circumstances, what would be CCS's 2017 deductible charitable contribution? What would be its charitable contribution carryover? And when would the carryover expire? Well, it's not all that difficult because things we've taken out already, these items, well, we said we are going to calculate the 10% before we take those items out, so we just add those items back. 10% of that total gives us $4,800, and then we would take the lesser of what we already paid, or the amount that I just said, which in this case would be that max. So that gives us $200 more to carry back into future years.